This will be a review of the differences in handling inventory, the differences between a perpetual and a periodic system. Under a perpetual system, you're updating your inventory account with every purchase, and you're also updating that same inventory account at the time of every sale, as well as always recording cost of goods sold immediately at the point of the sale. Periodic system is different. You wait to update your inventory and calculate your cost of goods sold until the end of the period, and that's thought of as your end of year or end of month adjusting journal entry. Usually companies that are using a periodic system do wait until the end of the year. Inventory purchases are also recorded a little differently under a periodic system. So we'll look at the purchases first. Under a perpetual system, you debit merchandise inventory and usually credit accounts payable, or it could be cash. But a purchase under a periodic, there are different accounts. There are some temporary accounts under a periodic system that simply do not exist under a perpetual. And that one of the temporary accounts is called purchases. For a return under a perpetual, because you're perpetually or constantly updating your inventory account, if you return something, you need to reduce that inventory account. And also, if you recorded it in a payable account, you need to reduce that payable because you now owe them less. You returned some inventory. On a periodic system, the returns go into another temporary account called purchase returns and allowances. And that's another one of those special periodic system accounts that does not exist in a perpetual system. For the sales, let's look at the differences. Notice under a perpetual, I record the revenue, accounts receivable and sales. Same as a periodic, accounts receivable and sales. But only under the perpetual do I immediately record cost of goods sold and a decrease in merchandise inventory. And why is it decreased? Because I sold it, it went out the door. Returns are also look different. We have sales returns and allowances and accounts receivable. And I want to track that sales returns and allowance separate from sales simply for tracking purposes. It's known as a contra revenue account. Also notice with the return under the perpetual, I increased the inventory account and decreased the cost of goods sold because this time instead of a purchase return, it's a sales return. Instead of me returning it to my supplier, my customer returned it to me. So if I can put it back on the shelf and resell it, if there's nothing wrong with it, I put it back into merchandise inventory. Now the year-end cost of goods sold calculation. Under a perpetual, you don't have to do one because you've perpetually kept track of your cost of goods sold with each and every sale. Cost of goods sold and ending inventory are updated periodically throughout the year or constantly throughout the year, perpetually throughout the year. Now on the periodic system, because you haven't done it yet, you have to make that adjustment. Now notice with this journal entry you have a debit to inventory and also a credit to inventory. Now you may be tempted to just net this number out, but it's not a good idea. This actually is a good audit trail. It's a way that the auditor can come in and quickly look at this journal entry and really follow the money. The inventory is your number from the beginning of the year, but that number has not changed because you haven't touched this account in a periodic. Everything has gone into those temporary accounts. Purchases, purchase returns and allowances, freight in. You may also have another account called purchase discounts, another temporary account. Those accounts do not exist in a perpetual system. So I have to remove the beginning inventory and then put on that ending inventory. And how do I get that ending inventory? That's an actual physical inventory count. So the adjustment or the balance, the plug number, is solving for cost of goods sold. The actual physical inventory count is crucial to calculating ending cost of goods sold, and any shrinkage is actually absorbed in cost of goods sold. So that's one of the downsides of a periodic system. You can't really track for shrinkage, where you can better in a perpetual system. You can identify, hey, our numbers don't balance. Was there spoilage or even possibly even theft. That's what shrinkage is. So looking at the accounts, notice these are all the same, perpetual and periodic, but the periodic is the one that has additional temporary accounts. And as you saw on the prior slide, those temporary accounts are then closed to the new ending inventory number. Those accounts simply do not exist in a perpetual system.